All down. All silent. Going. Go. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another edition of Current Market Insights. I'm your host, Kieran O'Brien, and with me is my good friend and our local favourite, Mr. Peter O'Malley. Peter, hello.
G'day, Kieran. Great to see you.
Great to see you, Peter. I wanted to start tonight's episode by talking about last week's episode, actually. We did an episode on underquoting, and I must say the feedback online has been incredibly strong. People seem really fired up over what we spoke about. And I've had a few calls and emails from people saying that they loved what we had to talk about. And I wanted to get your thoughts on why you think that is and if you've had a similar response.
Yes, I think it was one of the most emotional or motive reactions to one of our podcasts, Kieran. And that's because most people have been operating in the property market that we speak to and have been a victim or influenced by underquoting, and they're very frustrated by it. Because to the consumer, it's A, unnecessary, and B, and I think this is a really big point, no other facet of society, of professional society, conducts itself the way real estate agents do with underquoting. The regulators have clearly lost control of managing the issue. It is out of control at the moment, which is why we spoke about 20% underquote is now the new 10% underquote, and consumers are aggrieved by it.
It's interesting. I actually saw some commentary on Twitter from some buyer's agents, quite reputable buyer's agents, saying that their experience is that that's 100% true, that it really is 20% as a minimum now. And they're guiding their clients that if they come to them with a property, really they need to factor this in or they've got no chance.
Yeah, and buyer's agents are better positioned to help consumers avoid being underquoted because they know the style that certain agents and agencies operate with. So when they hear that such and such has got 10 Smith Street listed, for example, they say, well, look, I've bid at such and 10 or 20 of such and such as auctions, and they tend to go somewhere between 15 and 25% above the agent's initial guide. So don't get too excited about the price of the property at this stage because history tells me that it's going to go up pretty dramatically from here. Buyer's agents have got that historical knowledge, if you like, about the way agents in a certain marketplace operate, where consumers turn up often, certainly for the first one or two auctions, they turn up in good faith, naively, we call them auction bunnies, as you know, thinking that the agent's price guide is somehow loosely related to the truth.
And I must point out for our listeners, as I did a long time ago, actually, when we first started the podcast, I myself was an auction bunny, even with the knowledge that I have around this. And that's how easy it is to get caught up in the frenzy and how, I guess, misleading and confident these agents can be whilst openly lying to you about
persuasive.
The price. Persuasive.
You're led to believe there was very few, if anyone else interested, turn up on the day. You never know. You could be lucky. And as lo and behold, you turned up as part of a fairly strong cohort of other bidders, and you were just one of many vying for the property on the night, yeah?
I was only 600,000 short, Peter, which is a bit of a shock to us at the time.
It wasn't a shock to me.
Yeah, unfortunately, that is true. You did warn me. Just before we move on, I was thinking about this over the weekend, actually. It really reminds me of when GST first came in and people were very confused. You know, they'd go to the shops and think that something's $1 and in fact it's $1.10. I'd be furious I am furious actually when I go to the supermarket and I think something on sale and it's not. And it's, despite being a different area, it's a very similar feeling of being deceived when you just want to get something that you love. And you can't because it's not an honest and open transaction.
Yeah, quite often the buyer falls in love with the said property, Kieran, because they think they can buy it at a price they can't. So they fall in love with that notional concept, which turns out to be smoke and mirrors. I tell you a very subtle point that's not made about dummy bidding and underquoting, which I thought this was the case during the week, but just double-checked it today on the Department of Fair Trade's website. The Department of Fair Trade said it is illegal to make dummy bids at an auction. The seller of the property is entitled to have one bid made on their behalf by the auctioneer. When the seller's bid is made, the auctioneer must announce it as a vendor's bid. If you make dummy bids for the seller, you may be prosecuted and fined up to $55,000. The property seller who asked you to bid can also be fined up to $55,000, as can the agent and the auctioneer if they are involved in the arrangement. It's an offence to collude with someone to interfere with free and open competition at the auction. This offence carries a maximum fine of $55,000. A vendor is on the hook if they plant a dummy bidder. But if a vendor consents or allows a real estate agent to underquote the price of their property, whilst there could be, in theory, a penalty for the agent if they've deemed to have been underquoting, there is no penalty for the vendor. So you can see why there's been an explosion in underquoting since they introduced such draconian laws with dummy bidding, because there's no penalty for the vendor. All they have to do is consent to the agent using the underquote. Now, that's the first point. The second point, this will absolutely stun most people that hear this, but on the Department of Fair Trading website, it says, this is in the frequently asked questions section, Kieran, does the agent need my consent as the vendor before changing the estimated selling price? No. Under the laws, an agent must comply with the requirement to revise their estimated selling price if they receive evidence such as market feedback that changes their professional assessment of what your property is likely to sell for. They must advise you in writing what they've revised their estimate to, provide you with evidence of the reasonableness of the revision, and amend the agency agreement by including the revised estimated selling price. So if an agent does, I heard a story today of a property over on the North Shore. The real estate agent on the agency agreement said 3.5 to 3.8 million. And then in the first week of the campaign said, we actually think you need to start quoting 2.8 million to attract buyers to the property after the owner had signed an agency agreement. The agent, because they had revised their selling price, was compliant, then promoted 2.8 million on a property they said could achieve up to 3.8 million, and then everyone's shocked when it doesn't go past the low threes.
So under what you've just said, though, shouldn't they have been required to amend the agency agreement to include now the lower price?
Well, the thing about amending the price lower is the vendor doesn't get their advertising money back if they don't agree with it. They don't get to shorten the exclusive agency period. And by the agent giving a one-way document saying, here's our revised selling price, the agent has gone a long way towards setting themselves up to being able to legally underquote.
Yeah, unbelievable. And it is no surprise it's so widespread. And I find it ironic that I'm sure the majority of vendors that do agree to this practice were ones that complained about it themselves when they bought the home originally.
So this couple, all they want to do is sell their home and move on. They signed with the said agent, maybe naively, maybe not. I'll leave that out of it. They signed with the said agent and spent $8,000 on advertising because the agent was supremely confident that they could get 3.5 to 3.8. Nothing materially changed in the market conditions to justify a $700,000 to $1 million drop in the price quote. The agent was able to vary their terms of business, which is, I'm now walking away from my price promise of 3,538, but you're bound by the 90-day or 120-day exclusive agency agreement term that you signed with us.
Is there not a clause in that agreement that if the terms are varied by such an amount that it's now well outside the legal range of 10%, can they not walk away?
No.
Unbelievable.
And this is from the Department of Fair Trade.
Yeah, fair trade, I don't think so. But it just underpins what we always say, which is you need to do your research on property prices, but also with your agent and make sure you get the right one.
And the most powerful time as a real estate vendor or prospective vendor coming to market is before you sign an agreement. Once you've signed an agreement, as we've just articulated, all the power rests with the agent.
Yeah, unfortunately, very true. I want to switch topics now, Peter. Something, I guess, a little more serious. There's been a lot happening around the world. It's a bit of a strange time, I think, for a lot of people and for some of our younger listeners, maybe completely new times. But we talked about on the podcast previously the impact of China and its economy. We talked about Ukraine war with Russia and the implications that was having on the global economy. Given what's happening in the Middle East and how it's now expanding, neighbouring countries are getting involved. Do you think that we're likely to see similar shifts in market economics, and is there likely to be a flow-on effect here in Australia?
To the housing market, I assume you mean?
Yeah, look, I guess broadly, do you think there's going to be economic implications? And then in terms of property, is there likely to be a flow-on effect for buyers and sellers here?
Look, if it erupts any further than what it's looking like or what has happened to date, and Iran and Israel tee off and the whole Middle East is on fire, so to speak, I think the most obvious impact for consumers and people here in Australia is the disruption to supply chains and travel routes, and that will be inflationary. And the inflationary outbreak that we're experiencing at the moment is a legacy of the supply chain issues that occurred during COVID and at the end of COVID, with hundreds of containers just sitting on docks in America, for example, and they just couldn't get to it and everything was backlogged. And by the time they managed to clear that backlog, inflation had been set racing globally for goods. And the genie, as they say in economics, the genie's out of the bottle. So we all hope that peace holds in the Middle East and there's not a mass eruption of events. But if there is, I think the most likely impact for consumers and people would notice in their everyday life here in Australia, which is always benefits from its isolation in times like this, would be an impact to the supply chain issue, which puts upward pressure on interest rates, encourages policymakers to have a restrictive setting. And just in the last 24 hours, we've already seen that Powell has walked back his rate cut promise and said that rates will need to stay higher for longer. Quote unquote, he said it'll likely take more time for officials to gain the necessary confidence that price growth is headed toward the Fed's 2% goal before they lower borrowing costs. If price pressures persist, the Fed can keep rates steady for as long as needed. So I think they're the most likely immediate ramifications for consumers and home buyers if something far away in the Middle East did become more concerning and real than what it already is.
Okay, we'll pivot to the US inflation numbers and Jerome Powell's comments in a second. I just want to get your thoughts on whether or not the involvement of nations like Israel and Iran is likely to have a larger impact on us economically than, say, Ukraine versus Russia, where...
I think so, because the oil story.
Yeah,
it's not just supply chain, it's also the oil, right?
Yeah, of course. The Middle East is the oil bed.
Yeah.
Okay, so
it's not good. It's closer to home or more immediate impactful to us here in Australia than say the Ukraine-Russian conflict.
Yeah, look, certainly economically, and there's no doubt that what's happening in the Middle East and Ukraine is dreadful from a humanitarian perspective, but economically it's a terrible situation as well.
Now, it is interesting. Australia has a lot of gold, for example, and the gold price is going bananas. If you're following that, that's a really strong story.
I have been over $3,000, I think, an ounce at the moment in Australia.
Australian dollar, well past that. I think it's 3,700.
Yeah, wow.
Yeah, so yeah, it is 3,700. So yeah, like things like that, and we do have some energy reserves here in Australia. So if the price goes up, again, Australia being the lucky country, we're isolated from these sorts of conflicts for the time being, and we've got great natural resources. So I was selling real estate when the Iraq war happened in 2003, and I thought, well, this will change everything. The market could take a real big knock. And what it did is it just made people feel more comfortable with bricks and mortar close to home. So if a regional conflict in the Middle East did escalate, you would suspect that share markets would take a serious knock. I think share markets are set for a correction at the moment anyway, because they've priced in rate cuts that don't look to be coming. And if the share market took a serious knock or had a correction due to the Middle East conflict, it would make people feel more comfortable with bricks and mortar in Sydney, in Australia. A, it's isolated from such matters, and B, it's tangible bricks and mortars rather than riding the ups and downs of the share market on a daily fashion. And that's what we saw in 2003, when I thought the residential real estate market may take a knock from what was going on in Iraq, and it was actually the opposite that happened.
So with that in mind, do you think that we are likely to see any significant shifts in the Australian dollar? And will that, if it does shift, is it going to result in more foreign buyers using that leverage to come here and, as you say, secure bricks and mortar in a country that's completely isolated from what's happening?
Oh, indeed. I think Australia has great appeal in times like this. There's no doubt about that. If the RBA cut rates before the US Federal Reserve do, the Australian dollar will head south. There's no doubt about that. The American dollar is going up against all other currencies at the moment, as it tends to in geopolitical times like this. So aside from the American dollar, the Australian dollar is holding ground against a lot of other currencies, particularly Pacific currencies, and the weakest currency is the Japanese yen. If you want to go to Tokyo, now's the time. Their currency is getting absolutely belted due to their monetary position and how they've been managing themselves. But I just don't think the RBA will cut prematurely when the rest of the world are saying, no, we're holding.
Yeah, look, good thoughts, and actually a perfect transition really to talk about the just finally the US inflation figures. So US inflation at the moment, I know Jerome Powell said, was at 3.5%, and their cash rate, interestingly, is 5.5%. Now, if we compare that to Australia, our inflation rate here is 3.4%, but our cash rate is only 4.35%, which really just underpins what you've said, that Australia, whilst it seems dire here, we can't afford to cut rates so early, particularly when inflation is not under control and when we are so not beholden, but certainly follow the trajectory of the US economy in terms of how our inflation and our currency work. It would be foolish, it seems, to cut too early when the economy that we're trailing is actually behind us in terms of their positioning.
Yeah, look, the only caveat to that, you're absolutely right with all of that, Kieran. The only caveat to that is during 2020, 2021, when both countries' housing markets went mad and boomed, if you took a home loan to purchase a home in America, you enjoyed that low interest rate for the term of the loan, for the full
that's right.
25 or 30 years. Where when you look here at Australia, you get a fixed term, and then you're back to the floating market rate, the variable rate, of course.
Yeah.
So that's why the Australian goes a long way to explaining why the Australian cash rate is so much lower than the American, because the Americans had to dial it up harder and faster to have the impact on the economy in comparison to what the RBA need to do. The adjunct of that is hot money chases yield, and that's why the American dollar has performed so strongly against the Australian dollar.
Yeah, of course. And I know many people, myself included, wish that we had, lifelong mortgage fixed rates here in Australia. But it's, we may look back on this period and think we're lucky that we didn't actually go down that pathway.
Well, we must keep in mind that banks have been toppling in America in the last few years. And if they've lent all this money out at 2% and they've got to go to the market now, and as you've just said, the cash rate in America is 5.5%, and they've got to pay market rate to get funds, they're losing money. And that's why the smaller banks that can't see it through are falling over. At the start of 2023, I think it was, you had 2 or 3 US banks just disappear over a weekend. There was a run. When there's a run on a bank now, people don't line up out the front of the bank and say, give them the money back. They just go on their phone and transfer the money out of there, And that's what people did en masse with a couple of banks in America not so long ago, and the banks collapsed over a weekend. So that is the downside to having a lifetime interest rate on the home loan.
Yeah, absolutely. And it's certainly interesting times ahead, and we can't, as we said on the podcast before, we can't get too optimistic about a rate cut just yet because it's still a long way to go.
And central banks misplayed it, let's be honest. They came out of Christmas and the New Year and basically told the world over that you'll get rate cuts this year and help is on the way. And people just started behaving as though interest rates were heading down next week. And now here we are, Jerome Powell is going, hang on, higher for longer, where we won't be cutting rates on these numbers. It's like Jerome Powell is partly the cause of why inflation is persisting higher, because he's given everyone a false sense of comfort. He needs to be held to account for that. It's not quite Philip Lowe's. There'll be no rate cuts until 2024. When he was
rate rises, you mean?
Rate rises until 2024. Sorry, thank you. But it's a bit of an own goal, isn't it?
Oh, look, of course it is. And, I'm sure plenty of people out there have optimistically said, oh, look, we can be a little bit more ambitious with, even the cost of living, the groceries, whatever it might be, because it will get easier in, 6 months. We're all expecting September was our first prediction. Some banks had said maybe May. We're effectively in May now, and it doesn't look like any rate cuts are on the horizon, that's for sure.
Indeed.
Look, as we move to close up tonight, Peter, it's time for our favourite segment, the Market Wrap. And I know we love talking about clearance rates across Sydney. So what do you got for us?
So the week ending April 14, final clearance rate was 52% from 1,143 scheduled auctions. As is now customary, there were 206 properties of the reported auctions that sold prior and 209 that sold under the hammer. So the market's splitting 50-50, the auction market's splitting 50-50 between those that choose to transact before the big day and those that are transacting under the hammer on the day. I think they're reasonable, tidy numbers, particularly when the market is now slowly working out that rate cuts won't be coming in the short term like we thought there would be earlier in the year. I think the big takeout of the current market is stock levels have contracted sharply. That is a good story for vendors out there, and any buyer that's overplaying their hand needs to know that winter is coming and stock will only tighten further, and that will give vendors an advantage they'll enjoy right through until spring.
It's customary there to say, nothing, Jon Snow. Do you think then, just as we wrap up, with the with the sellers now getting a slight upper hand, do you think there are enough buyers out there at the moment to match if there was a sudden flurry of sellers come to market?
I think so. I think there is. We saw some really strong open houses again last weekend and the weekend before. There's definitely buyer demand in the marketplace, and some buyers have got more of an advantage than others because they're coming into the country with currencies that have performed really strongly against the Australian dollar. So, whilst our housing market might be feeling expensive for someone that's earning the Australian dollar, but for someone who's coming from one of these countries that have benefited from the currency shift over the last 12, 18 months, they're arriving here and saying this is good times.
Peter, I can actually, 100% verify. I met with a lovely couple just last week from the US who were in that exact scenario. They had money to spend because the currency was so strong.
Yeah, indeed.
Indeed. Well, look, Peter, really great episode today. A really, really good recap, and I think some interesting but concerning topics across the board for us. I really thank you for coming along and having a chat.
Anytime. Thanks, Kieran.
And thanks to everyone for listening to Current Market Insights. We look forward to talking with you next time.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.